Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We continue our topic about investment. Last time we discussed about debt investments. We had three categories: held for collection, debt investment, held for collection and selling, and held for trading. Yeah? And you use different valuation method for different types of debt investment. Yeah? We have amortized cost for held for collection, and then we use fair value for held for collection and selling, and fair value for held for trading. But different valuation applies to held for collection and selling and held for trading. Yeah. Okay, now we talk about equity investments. So basically, equity investments is when our company buys other companies' shares. Yeah, so we become the shareholders of other company. Yeah, so it basically represents ownership interests. Yeah, whether we buy ordinary shares or preference shares or other types of shares of another company. Yeah. So it could be representing the ownership interest in the ordinary share, preference shares, or other capital shares, or it can be also the rights to acquire or dispose the ownership interest at an agreed or determined price, yeah, such as warrants. We talked about warrants in the previous chapters, right? Where warrants or rights, yeah, the certificate certifying that we have certain rights to buy the shares of the company at a specific price, which is normally lower than the market price. Okay. So that equity investment could be either the interest in the ownership in the ordinary preference shares, or it could be the rights in the form of warrants or share rights. Yeah. So how do we determine the cost of equity investment? It's basically the purchase price of that equity investment itself. Yeah. Unlike the fixed asset or intangible asset, where you include other costs that is needed to acquire such asset, but equity investment, it shouldn't include any other fees that are needed when we purchase such investment or equity investment. Yeah? So the costs only include the purchase price of the equity. Yeah? Meanwhile, other fees like brokers' commissions or any other legal fees that needs to be incurred in us purchasing the shares of other company, it will be recorded as an expense. We don't include it in the value of the equity investment. Yeah? Okay, the percentage or the extent of which one corporation investor, let's say our company, acquires the interest in other company, or we call it as investee, yeah, the company that we buys the shares or we buys the warrants, etc., will influence the accounting treatment for the investment subsequent to the acquisition. Yeah. So how many percentage our ownership interest in the other company will determine how do we record, yeah, how do we treat from accounting perspective such investment. Yeah. Okay, for example, yeah, if we own 0% until 20%, means 0 point plus, right? Of course, if you own only 0%, then you don't have any ownership in that company. Okay, so basically from the range of 0% until 20%, which means that the level of influence, yeah, our influence toward that company is basically little, very little, yeah, and in that case, we use the valuation method of fair value. Yeah. So 0 until 20% ownership interest in that company, where we have a little influence towards the decision making in that company, means we have to value that investments after the purchase transaction at the fair value method. Yeah. Okay, what if our ownership interest is from 20% until 50%, yeah? Above 20% but below 50%. Yeah? That means we have a significant influence in the company. Okay? So in that instance, we have to use equity method to value the equity investment in that company. Yeah? Okay, if the investor has above 50% ownership interest in that company, means it have a significant control over the company. So we have to use the consolidation method. Okay, we'll discuss each method. So when it is above 50%, means we become the parents company of the investee's company. Yeah, so the investee become the subsidiary. Yeah, and the investor become the parents company. Yeah, so they have to consolidate. They have to combine the financial statements at the end of the accounting period. Yeah. Okay, for the first category of the equity investment where the company hold less than 20%, its majority, it has to be recognized as a trading equity investment, but they are also allowed to classify certain equity investment as a non-trading equity investment. But the valuation of both categories will be at the fair value, but it is different. The trading equity investments, any changes in recognizing the fair value at the end of the accounting period will be recognized in the net income, yeah, or in the income statement. Yeah? Any unrealized holding gain or loss, yeah, which is caused by the change in fair value, it will be recognized in the income statement. Yeah? But for the non-trading category, any change in the fair value which result in the unrealized holding gain or loss will be recognized in other comprehensive income, yeah, which is part of a separate component of equity. Yeah? Okay. Other income effects is basically the same. Any dividends declared, we need to recognize as our dividend revenue. Yeah? And any gains or losses from the sale of that equity investment, it needs to be recognized in the income statement. Yeah? Okay, for the category of equity investment which the company holds between 20 until 50%, then we need to use equity method. Yeah? When we use equity method, we don't recognize any unrealized holding gain or losses because we don't base on the fair value. Yeah? But it has the income effects because if the investee, yeah, where we invest our money, let's say they make a profit during the year, we will recognize certain percentage of that profit to become our profit, and it will increase the value of our equity investment. Yeah, and if the investee incur the loss, it will reduce our equity investment. And if the dividend is paid to us, then it will also reduce the equity investment. We'll see it in detail later on. Meanwhile, for the company investor who holds more than 50% of the investee's ownership interest, then we use the consolidation method. Yeah? We combine the financial statements. Yeah? If you ever check the financial statements of companies, they would have parents and then subsidiary and then consolidated financial statements. Yeah, and so it doesn't have any effect of unrealized holding gain or loss, and it doesn't have any other income effects when it is consolidated. Yeah? Okay, now we see for the equity investments under the category of holding of less than 20%. So IFRS generally presumes that all equity investments that are less than 20% ownership interest are classified as held for trading, and we use fair value method to measure the equity investment subsequent to the purchase at the beginning. Yeah? Okay, and because we classify as a trading, yeah, so any unrealized gain and losses will be reported in the net income or in the income statement. Yeah. But if it is classified as non-trading, it is allowed. Yeah, certain categories, certain types of equity investment could be included as a non-trading equity investments. We'll use fair value as well, but any unrealized holding gain or loss we report it in the equity as part as other comprehensive income. For example, this company purchased 3 types of shares from different companies, yeah, and the shares are classified as held for trading. So we'll record the equity investments total as debit equity investments and credit cash. Okay, so it's usual. It's very rational double entry. You don't need to memorize it actually. Okay, and if it receives cash dividend, then we record debit cash and credit dividend revenue. Okay, as usual, yeah, what you have been recording from the beginning of accounting subject. Yeah. Okay, so we said that held for trading equity investment we use fair value method. So at the end of the accounting period, we'll identify the fair value of each equity investment, yeah, or the class of the shares that we purchase, and we identify the unrealized gain or loss, and we get the net fair value adjustment. Yeah, if it is in bracket means there is unrealized loss. Yeah, so we will record that unrealized fair value adjustment to the income statement as debit unrealized holding gain or loss to the income statement and credit fair value adjustment. Okay. Okay, let's say later on the company sell one of its equity investment. Okay, and the cost of that equity investment was 259,700, and the selling price is above that, yeah, which is 287,220. So the company gets the gain on sale of shares, the amount of 27,520. So we would record when we sell something, we get the cash, we debit the cash for the selling price, and then we close off that equity investment account because we already dispose it, we sell it, so we credit equity investment, yeah, 259,700. And if you notice the debit side is more than the credit side, it means we need something to balance in the credit side. When it is in credit side, it should be the gain, yeah, gain on sale of investment, which will be recorded in the income statement. Okay. Okay, let's say later on the company purchase another types of shares, yeah, from another company, yeah, plus brokerage commission, yeah. So now it will add. Just now we have sold one category of equity investment, and now we add another equity investment from another company. Yeah, so we will update the equity investment portfolio. And then at the end of accounting period, we need to identify the fair value adjustment for the whole equity investment portfolio. Yeah? And we will record, because the fair value adjustment now is positive, that means there is unrealized gain. Yeah, so unrealized gain will debit fair value adjustment, and we credit unrealized gain transferred to the income income statement. If it is credit, means it is gain. Okay. Okay, for non-trading equity investment, the way we recorded the accounting entries is the same like trading equity investment, but the unrealized holding gain or loss will not be transferred to the income statement, but it will be transferred to other comprehensive income, yeah? A separate account in the equity. Okay. Okay, you can try this example. When you buy equity, you can debit equity investment and credit cash. And then to record the dividend revenue, I will not elaborate it anymore. This is the, just to show that unrealized holding gain or loss, it doesn't go to income statement. Okay, it goes to equity. Okay. So non-trading, remember for that, okay? Just like debt investment, yeah? Help for collection and selling, it goes to equity, but help for trading, it goes to income statement. Okay, this is how it is presented on the financial statement. So we have investment in the statement of financial position, and then the amount of unrealized holding gain or loss, it goes to equity under the account of accumulated other comprehensive gain if it is gain. Yeah, if it is loss, then we have to report loss. Okay. Okay. Now we move to the second category of equity investment. What I mean category is if the ownership interest is, just now it was less than 20%. Now it is more than 20% up until 50%. Yeah. So in this classification of equity investment, we don't use fair value method, but we use equity method. Yeah, because we assume that the company investor has a significant influence over an investee. Because it has a significant influence, so any operational activities of the investee is assumed to have an effect to the investor. Yeah. So if the investee makes a profit, makes a loss out of its operation, so we assume that it will have a proportionate effect to the investor. Yeah. So that's why we use the equity method. Okay. Okay. For equity method, when we purchase and when we acquire that equity investment, we record at the purchase price, yeah, the same like other classification of equity investment. And subsequently, we adjust the amount of each period for changes in investee's net assets. Yeah? What do we mean by changes in investee's net assets? If the investee's company reports the earning or losses, it will increase or decrease the investment's carrying value. Yeah? If the investee report a profit, then it will increase our investment carrying value. If it report a loss, then it will subsequently decrease the equity investment of the investor. Yeah? Secondly, any dividend received from the investee is assumed to reduce the investment's carrying value. Yeah? We assume that we have received the return from the company, from the investee, so it would reduce our equity investment. Okay. Okay, but there is an additional rule that needs to be remembered. If investors' shares of investors' losses exceeds the carrying amount of the investment, then the investor will not apply anymore the equity method, yeah, and it will not recognize any additional losses. Okay, for example, company A buys the share 25% of the company's B, and the company's B report the loss. Yeah, so company A will use equity method up to the maximum of its investment amount. Yeah? If the losses, let's say the company B continue to incur losses, the losses already beyond the investment amount, then they will not anymore implement the equity method. Yeah? Because they cannot recognize additional losses beyond their equity investment. Okay. Now we compare the fair value and equity method. Okay. On the purchase date or on acquisition date, the same value will be reported under both method. Yeah, because we recognize the cost as the purchase price. Yeah. Okay, let's say at the end of the year, yeah, the investee, which is mini company, reports the net income of 200,000. And Maxi company or the investors share is 20%. So the share of this net income for the investor is 40,000. Under fair value method for the ownership interest of less than 20% just now in the beginning classification of equity investment, any net income or losses from the investee will not have any effect to the investor. Yeah? So under fair value method, there is no any entry. But under equity method, it will have an effect to the investor. Yeah? So we will recognize the share of the net profit of the investee, which is 40,000. And we say that if there is a profit, it will increase our equity investment. So that's why we debit equity investment and we credit investment income. Yeah. Okay, let's say at December 31st, 2019 as well, the investee, 48,000 shares have a fair value of 12 a share or 576,000. Yeah? So under fair value method, we need to recognize the changes in the fair value. Yeah. So 576 minus 480. Yeah. So we have unrealized gain. Yeah, because the fair value is more than the cost. Okay, so we report that as debit fair value adjustment and credit unrealized holding gain or loss, 96,000. Do we need to record anything under equity? No, because equity we don't consider any fair value adjustment. Okay. On January 28 next year, the investee announced and paid a cash dividend of 100,000. Yeah. Maxi company receive, the investor received 20% or 20,000. Yeah. Okay, dividend we will record under both method. Yeah. Okay, regardless fair value or equity method, dividend will be regarded as it needs to be recorded under both method, but differently. Under fair value, we regard it as a dividend revenue. But under equity method, the dividend received will reduce the amount of equity investment. That's why we credit equity investment. Okay. Let's say next year, the company, the investee report a net loss of 50,000. The investor shares is 20%, so the loss to be proportionate to the investor is 10,000. Under fair value method, we don't need to record anything. But under equity, yes, the loss will decrease the equity investment. So we debit investment loss and we credit equity investment. Yeah. Okay. And then at the end of 2020, the company reports the change in fair value. Again, this is similar to the previous one that we have tried. yeah, on December 31st, 2019. So under fair value method, we need to recognize the change in the fair value. But under equity method, no recognition to the changes in the fair value. Okay. Okay, next, the last category based on the ownership interest. Yeah, the last category of equity investment is where the investor holds more than 50%, and which means that the company has the controlling interest, yeah, of another company, yeah, or the investee. So in this case, like I mentioned before, the investor is referred as a parent company, yeah, the investee as a subsidiary. Okay? So the investment in the subsidiary is reported on the parent's book as a long-term investment. Okay. We don't report it as like other category as equity investment. Okay, and we need to prepare, the parent needs to prepare the consolidated financial statements. Okay, okay, consolidated, please check the financial statements of any big company, listed company mostly. They normally have many subsidiaries. Yeah? So their financial statement will have different columns. Okay, parent, subsidiary, and consolidated. Yeah? So they have three different amounts to be reported for all the items on the financial statement. I will stop on that. With this, I will provide another lecture on other reporting issues for the investment. Thank you. Wish you all the best. Please study hard. Assalamualaikum.